Good afternoon. I'm David Wessel. I'm director of the Hutchins Center on Fiscal and Monetary Policy here at Brookings, and I want to add my welcome to that of Ben Bernanke. If I had heard Gary speak before we had framed this event, I would have framed it as, how can we make sure that no Yale professors will stand up here in 2115 and say, how could they have been so stupid back in 2015? So that's my new goal, is to help identify those things that we're doing today that the next generation will deride as stupid. I think we should avoid those. One of the big changes in the financial system as a result of the crisis has been some changes in the way the Treasury bond market works, and there have been frequent assertions that there's less liquidity in the bond market, and that will lead to the unintended consequences of the sort that Gary Gorton has been warning us about. So we're going to turn to that now. We're very fortunate to have a presentation by Darrell Duffy, who I learned by reading his bio, started his career in civil engineering, and then moved to financial engineering. Darrell's been teaching at the Stanford Business School since 1984, and we're particularly grateful for him joining us here today because he's actually on sabbatical in Switzerland and made a trip here just for this event, for which we're very grateful. He'll be followed by two discussants. One is Victoria Ivashina, who has been teaching MBA's finance at the Harvard Business School since 2006. And the other is Nellie Lang, who has been at the Fed since 1986 and was designated by Ben Bernanke to make sure that we never have another financial crisis. Is that right? Do I have it right? That's not quite the way the job description reads, but she's now the Director of Financial Stability Policy at the Fed, which is an innovation meant to help us so that we don't at least get smashed in the face by something that we didn't see coming. I want to make one point here. The Federal Reserve ethics lawyers are very strict, and I promised them that there would be at no time would Ben Bernanke be on the stage at the same time as Nellie Lang or Dan Tarullo. So I have never worked for the Federal Reserve, I never will work for the Federal Reserve, and I never intend to seek an ethics opinion from the Federal Reserve, so I'm free to do that. We're going to start with Darrell Duffy for 18 minutes, then Nellie and Victoria will come up, and then we'll, as we did before, have a little discussion and invite you to join us. So Darrell?
Thanks very much, David. It's good to see you all again. So I'm not quite as pessimistic as Gary. I do think we've done something to improve financial stability. But the question is, and there's been a constant drumbeat of questions, has that changed bond market liquidity in a significant way? So if you follow the Financial Times or Bloomberg, or even more popular press like New York Times, is just almost every day there's something. Often, of course, it's a bank that says the regulations have gone too far and bond market liquidity has been very severely impaired, but even others have said so. What I'd like to do is to take everyone through a quick tour of how that might happen and whether there's evidence that it has happened. So first of all, how it might have happened. I'll just go briefly through the list of possible channels by which changes in regulation might have caused a deterioration or a change, at least, in bond market liquidity. The first one is sometimes called agency intermediation, which means that when a bank is subjected to higher capital requirements, and I work for a bank broker-dealer, and therefore I'm subjected to those capital requirements. Gary calls me and says he wants to sell a $50 million corporate bond position. Before the new capital requirements, I might have said, sure, here's my bid and ask. Now I'm more likely to say than I was before, hang on a second, Gary, and I'm going to go look for buyers for your position. And I'll act as an agent, effectively, for your trade. And when I get a buyer, maybe David, I'll get 10 million. Then I'll look for buyers for the other 40 million, and over the next few days, we'll work down your order. So that's called agency intermediation. That's one way that Gary might get less immediacy for his trade demands than before. Another way that it might happen is that central counterparties can come into play. So this time, if I have long and short swap positions of, say, 100 million with two different counterparties, that's a lot of regulatory capital. One way I might deal with that problem is to take the long position, send it to a central counterparty, take the short position, send it to the same central counterparty. The long cancels against the short, and now I don't have a large position against which I need to hold regulatory capital. So there's going to be more incentive to move positions into CCPs. And that's already happened in the swap market, and there's a lot of movement in the United States to have that happen in the bond market as well, particularly for repos. The next thing that, that might happen is that the bonds won't be handled by banks at all. They'll be handled by all-to-all trade on electronic trading platforms like BrokerTech, MarketAxess, Bloomberg, TradeWeb, where ultimate investor meets ultimate investor directly and anonymously in a central limit order book. So the banks are basically being disintermediated by that. In the bond market, there's a lot of that in treasuries, not so much in the corporate bond market, but it is growing from a low base. Another thing that, that I might do is to shift from, and this is something that, reflecting something that Betsy said, I might shift from intermediating low-risk products where my profit margins can't be high enough to overcome the regulatory capital to higher-risk products. And Ben alluded to the fact that if you have risk-weighted capital that's appropriate, then that shouldn't be a problem. However, we have, and Ben alluded to that as well, an additional capital requirement called the supplementary leverage ratio, which doesn't distinguish between high-risk and low-risk assets. And I'll get on in a few minutes to whether or not there may be implications there. And then another potential is that, and again, this is reminiscent of what Gary said, there could be some shadow bank intermediation, or maybe we should call it shadow broker-dealer intermediation, where a broker-dealer that's not affiliated with the bank and therefore is not subjected to these new financial stability requirements could step in. And that could be a good thing because it's farther from the core of the financial system, or it might be a bad thing if it's not well regulated. My overall message, the usual measures of liquidity look pretty darn good considering how much change there's been in this last round of financial reform. That is, in my view, we've gotten a lot of financial stability, and so far there's not that much sign of serious problems with bond market liquidity. I'll give you one or two exceptions to that, but overall it's kind of surprising that we've done as well as we have considering all the changes that have been made. Now, the whole story is still playing out because, as everyone knows, it won't be long before interest rate policy at the central bank starts to normalize. We'll see more bond market volatility that has good effects and bad effects. Good effect is when there's more changes in prices, people have more reasons to trade, and liquidity will improve from just simply more reasons to trade. There'll be more activity in markets. The bad effect is we'll find out whether, with all of these changes, the market can handle some of the sudden rushes for exits that are going to occur as people who are used to holding bonds that trade at very low yields to trading bonds whose yields are jumping around a lot more. Here comes my quick tour of what we're actually seeing in bond market liquidity. Except for a short period during the financial crisis, remarkably stable, low bid-ask spreads in the Treasury market across all of the main benchmark issues, the 2 years, the 5 years, and the 10 years. By the way, that spike is interesting because it says when shocks occur, shouldn't think of Treasuries as immune from changes in liquidity. And that is important because if liquidity in Treasuries goes down, a major shock could mean that Treasuries won't be the same kind of liquid safe haven that they've always been felt to be in the past. What about price impacts, meaning how much does the price of Treasuries change when there's a sudden trade? It varies a lot over time. It's not obviously much worse than it's been in the past. It's a little bit higher now. And there's been a lot made of the recent increases in price impacts, but I wouldn't say this is a disaster. Where do we see potential problems with bond market liquidity? Well, turnover is generally down, both in the Treasuries market, the corporate market, municipal bond market. The number of bonds going through the market on a given day as a fraction of the outstanding supply of those bonds is dramatically, I would say, lower. I'll give you some examples in a minute. What that means is that if you have to get a very large position through the market, you're going to have to be more patient. What else do we see that might be a concern? The derivatives markets that are used to hedge bond markets are changing significantly. The one that I would like to single out is the single name credit default swap market. Not a highly popular security in the narrative of the financial crisis, but nevertheless an important way to handle risk in corporate bond markets. That market is really suffering in terms of the amount of activity that is occurring. It's getting less useful as a source of hedging for the corporate bond market and as a source of price discovery. And the one that I promised to come back to that's being impinged upon by the supplementary leverage ratio is the Treasury repo market, where I'll give you an example. Treasury market turnover is significantly down, and the amount of repo trading of treasuries between dealers is very substantially down. This is from a slide prepared by Antoine Martin of the Federal Reserve Bank of New York, which, by the way, has done a lot of good work on bond market liquidity over the last month. Go see their website and the Liberty Street blog. So why is this happening? It's, again, because Treasury repo, let's say I have a $100 million Treasury repo position. This is a fully collateralized, over-collateralized by U.S. Treasuries. It's a very safe position. But the amount of regulatory capital I would have to apply to that position is exactly the same as if it were a real estate loan. Because of that, I'd rather make real estate loans because they have a wider profit margin, so I'm declining to use my balance sheet to provide intermediation to the repo market. Another way to look at that is that if you try to borrow money in the using treasuries as collateral for 1 month, you're now going to pay higher interest rate than you would if you borrowed as a bank in the unsecured borrowing market. About 10 basis points, I looked at it yesterday. Let me repeat that because it's quite a remarkable change. Again, if you want to enter the repo market and borrow money collateralized by treasuries, you're going to pay higher interest rate than a bank would pay if it borrowed without any collateral. And you might ask, how is that possible? It's partly because the repo trades have to leap onto bank balance sheets to arbitrage that difference, and the banks don't want to have those trades come onto their balance sheets, at least not nearly as much as they did. Treasury futures trade sizes are down. Why is that? It's a lot of these changes are related to the fact that as broker-dealers affiliated with banks pull back somewhat from the market, the best bids and offers are being done by high-frequency traders on electronic platforms, whether it's at the Chicago Mercantile Exchange or at interdealer broker trade platforms like BrokerTech. About 80%, it was suggested, of trades recently in BrokerTech are high frequency, and that's the largest limit order book market for treasuries. What about the corporate bond market? Again, the story is quite benign with respect to bid-ask spreads. The market looks quite good in terms of how much it costs you to trade small sizes. But trade sizes are down. So the tendency to try to push a large position through the market in a short time that we had before the financial crisis has changed to one in which we want to put smaller positions in order to get better price execution. By the way, this is not necessarily a sign that there's too little liquidity. It may be the case that there was too much liquidity before the financial crisis. It's also the case that this is not all induced by financial reform. There was already, well before the financial crisis, a movement towards high-frequency trading, all-to-all trading in the treasuries market, and a increased price transparency in markets through things called TRACE, or trade reporting, post-trade price reporting, that caused dealers to earn less profits in this market and provide less of their balance sheet to trading these bonds. So this is there are more trends at work here. And again, I already mentioned monetary policy. Turnover in the corporate and municipal bond market is down quite substantially. Again, this is the fraction of the outstanding supply that goes through the market on a given day. This is a sign that if you have all-to-all trading, that is, there's many competitors for your trade on a bond trading platform, then your costs go down, bid-ask spreads narrow, and dealer profit margins go down at the same time. What does that mean? That dealers are going to be less anxious to try to earn profits by participating in this market than they were before. So they're going to provide less liquidity to the market. That's not necessarily a bad thing, but it's just a sign that the market depth is probably not going to be what it was once before. I already mentioned the decline in the single-name CDS market. I'm going to move beyond that and turn to my last issue, which is one of the concerns that's been raised about the reduced balance sheets of the broker-dealers, the bank-affiliated broker-dealers in the bond market. Where do the bonds go, and what are the implications for that? This chart illustrates that where broker-dealers affiliated with banks were building up large positions before the financial crisis, the new bonds coming into the market are more and more being held by bond funds, ETFs, and mutual funds that own treasuries, corporate bonds, emerging market bonds, and the like. Some have suggested that that's a source of financial instability, because when there's a rush for the exits by mutual fund investors, who's going to catch these falling bonds? Will that cause, let's say, a fire sale or someone to topple over? I'm actually much more sanguine about that possibility than others, but it is a possibility to keep one's eye on. This is net monthly cash inflows to bond funds, and you can see at certain times, like during a so-called taper tantrum, you get very large flows out of bond funds in a very short period of time. This slide is from the Joint Staff Report on the U.S. Treasury market, showing that, again, volatility of flows in and out of bond funds is much higher recently than it was before. Again, when these big flows occur, will that cause a problem? The mutual funds themselves are not levered investors. Their investors may suffer some additional volatility in the value of their investments. The market value of their positions may go down quickly, and they may lose money if they try to sell immediately before the prices recover from the price impacts. But I myself am much, as I said, more sanguine about the likelihood that this would generate a financial crisis. Who, after all, is going to, as I indicate on this narrative, who, after all, is going to fail in terms of a systemically important financial institution? Not the banks, because the whole point of this exercise is that the banks are now much safer. They're not in the firing line. They're not large holders of these bonds. If you wanted to look for a potentially vulnerable victim of a fire sale in this market, where would you look? Maybe asset managers, but I don't think so. They themselves are not the investors, and they have a very wide diversified set of clienteles doing a wide range of trading strategies. Maybe the alternative asset managers, like hedge funds. Now, that's a place where I would tend to focus a little bit more attention, because they're large, levered investors. The number of extremely large hedge funds has grown dramatically. There are advantages to limited partners for getting out of those hedge funds quickly when they see trouble coming. And the portfolio managers that are the experts handling those positions, once they see that their employer is having difficulty, would themselves have an incentive to move. So that's a potential source of financial instability that I think we could pay more attention to. There's been increased focus by regulators on other large financial institutions like insurance firms that have exposure to changes in fixed income markets. And we may hear more about that later today, I hope. And Betsy already mentioned what's happening in the money market space, and I think that's something that's also playing out. So overall conclusion, it's too early to say. I'll just finish there. Thank you.
like this is me? No? Okay, so my slides are not here. Okay, so let me just start this. I think that in the big picture, Daryl is absolutely right in, I have a copy of my slides. Daryl is absolutely right in that it's too early to draw conclusions. The evidence that we have is not sufficient for us to start worrying, which is not to say that we have evidence that leads us that we should not worry, right? And there were many changes, structural changes out there, and so it's very hard to connect specific things. It's very hard to say, well, the dealers hold less inventory, and therefore that's the cause of liquidity. Actually, there is a long list, and Daryl pointed it out, that leads to the fact that liquidity had changed. And so it's a natural place to start here is to say, let's measure liquidity. And so Daryl took you through the tour of let's look at the liquidity and let's think about whether the average behavior of the average liquidity in the past few years indicative of something that we should worry about. So a good place to start here is treasuries, right? And so there we can go several measures. We can look at transaction cost, we can look at turnover, we can look at the depth of the market, we can look at the transaction size, we can look at the price impact. And on some measures, there is no impact, or at least not if you plot it on a magnitude as compared to 2008. And so on other measures, but on the most measures, I think the conclusion is the fact that there are spikes, and they're large spikes, not magnitude of 2008, but they're rare. And even if we look at the events as October of 2014, there is a big spike, but it quickly disappears, and so everything settles down. So that's on the side of treasury. So we have a very rich insight into liquidity on treasuries. Then we go into corporate bonds. On the corporate bonds, the picture is very similar. So there we start the measures of liquidity are less, and so because the market starts to get more liquid, and so on transaction costs, we still can measure it quite accurately, at least for corporate bonds as a general bucket, and so on the transaction cost, nothing happening much, turnover declining, but the outstanding increase, so not that much, transaction size is declining, so that's the evidence that we have. Overall, the magnitudes are not that dramatic. There are spikes, but they are rare and they disappear very quickly. That's the evidence. Now, the point that I want to raise is the fact that that's great, but we are measuring it where we can, as opposed to where we would like to. And not to say that I don't have an answer to. Nobody can measure what we would like to measure, so we're just looking at what we have. And so the first point is that we would like to measure risk. And when we're looking at the average liquidity, it's not an indicator for what will happen if there is a tail risk, if the dramatic drop in liquidity is possible or not. And Daryl raised the point and that was the second point that he did towards the end of his presentation, that thinking about market structure and asking yourself question as who exactly will fail, because it's not the mutual funds. Who exactly will fail and what forces escalate this into a broad financial stability crisis? That's where we should be thinking, the way we should be thinking about it. Now, the other point is that what should we exactly be measuring? And so treasuries is one of the most liquid asset classes. This is a $13 trillion market. It's much more liquid than the corporate bonds. It's less dependent on warehousing. It's a money-like securities that was brought up in the first section. And so then when we think about can we extrapolate from treasuries into corporate bonds, the answer is not quite. Another point is that in the corporate bonds, actually, there are many other buckets. Corporate bonds is this catch-all category, but there are these securities, there is very little standardization there. And so even at the highest level, investment grade, high yield bonds and leveraged loans, which is a form of bond, very close to bonds, have very different liquidity. So what I want to add to Daryl's presentation, although not with dramatically different conclusions, is bringing an asset class that is within this range of fixed income that stands out as being on the opposite extreme of the treasuries. So treasuries is one of the most liquid. If you're going to look at the spectrum of the fixed income, leveraged loans is something that is extremely liquid. Now it has loans in the name, which is why it might be often left out of the conversation. But actually, it's a syndicated loan. It's a high-yield, often rated loan product that is originated by banks but held by institutions. And so this is a much less standardized than bonds. I think I get more time because my slides were not uploaded. Okay. Just joking, I don't need it. I need to communicate points that otherwise would have been communicated on the slide. So it's a much less, so loans are even less standardized than bonds. If you want a space for reaching for yield, loans will be the ideal space where you can reach for yield because the contracts are just extremely long and there are many ways of making the contract looser and get an extra yield for something you barely understand. It's much less liquid than bonds. Forget treasuries. It's much less liquid than bonds. It takes 10 days in the best case scenarios to settle your transaction. It's now, it is a variable rate product as opposed to a bond, and so in terms of monetary policy, it will be reacting to different things. But here are a few things to mention. It might be left out of, another reason why it might be left out of a conversation that as compared to to corporate bonds, leveraged loans, high-yield loans that are sold to institutional investors are relatively small. All that said, it's a nearly $2 trillion market. And if you look at the post-crisis issuance of high-yield bonds versus high-yield loans, actually high-yield loans was much higher almost every single quarter. So, and it is not surprising that it's in the high-yield loan space that the mutual funds, the same points that we brought in before. So one of the concerns is that there was a large growth in high-yield mutual funds. And it's in the loan space, in the high-yield loan space, that's where it grew the most. So it goes from 20 billion towards its peak to nearly 170 billion, so it grew 8 times. And so it's a rich area for thinking about what will happen if the mutual funds start to redeem. I'm all set at this point. So, and another observation, so Daryl showed you the flows in and out of treasury mutual funds, in and out of corporate bond mutual funds. But now if we add precision to that and specifically zoom on this asset class, leveraged loans, the flows actually, they start to deteriorate in 2014. Of course, in November 2014 is, October and November 2014 is a big event in this market. That's also where it hits the bottom. Now, I wish I could show it to you, but that's a market where the mutual fund space grew by times, but it also been declining most dramatically, and it's been declining for 6 quarters by now, which I think this is a nice space to think about. If those mutual funds will run, what will be the consequences? Because we don't observe that one quarter it's oops, it's all bad, oops, it's all okay. So here you see several quarters of bad environment for mutual funds and several quarters of withdrawal from mutual funds, which to me leads to think that if this would be run, there would be an indication of, if this would be an environment prone to run, this would be an indication by now that there's something would show up. Now, on the left, so going back to liquidity, we started with, we can measure liquidity for treasuries very well, corporate bonds, very similar conclusions if you look at it as a bucket. But the graphs that Daryl was showing in his tour actually were at an annual frequency. And one of the conclusions about liquidity post-crisis is that it's very short, that the volatility is actually much higher in the shorter horizons. So for treasuries, for example, the intraday volatility, the spikes are much higher. And so if we zoom in on what happens to liquidity in this segment, in the leveraged loan market, you observe that actually there is a spike in 2014 exactly where we expected, but it doesn't disappear afterward. It comes down, but then for the past half a year, it's been going up. So the cost on trading in the leveraged loan market is going up in parallel with observations that I made that mutual funds actually continue withdrawing. Turnover, the drop in the third quarter of 2015 is 10%, the drop in the second quarter of 2015 is 3%. So there is a continuous decline in turnover. But all in all, these are relatively gradual deterioration, which is not something that we envision as a run. Now, the final point is the point that Darrell raised. So, all right, so we have to ask ourselves, though, given that these liquidity observations, who exactly would fail? What are the accelerating forces that would lead us to hit the bottom? Think about 2008. In the leveraged loan index, late 2007, trading in 95s, exactly where we are right now. And then in the fall of 2008, it falls to 60. From that level, so 90s, it goes to 60. So what could bring us from this 90s area to 60s? And so there we need to ask ourselves, what is the composition of this, who holds these loans? And important buckets to identify here are threefold. One is CLOs, collateralized loan obligations. The second one is, of course, mutual funds, which had grown in this market. And the third one is banks. Now, banks actually have been shrinking a lot, and this is resulting partly from this new macroprudential pressure from the Fed, because under the new leveraged loan guidance, this is precisely the asset class that is get targeted, and banks are very cautious in how much engagement they have in that layer. So banks have little on their balance sheet, even though they are the ones who drive this market. The CLOs, much bigger share, mutual funds also increased. What compressed? So I named the three things. Well, the thing that compressed is hedge funds, which is what Darrell said. Look for the leverage. You need leverage structures. And actually what squeezed out in the market was the leverage structures. There are some other agents, but they do not have leverage in the structure. And so what to bring you from 90s to 60, you need to identify the accelerating force. And that the starting point is mutual funds, but you also need an extra layer as to who will be forced to sell off in this market. Now, I need to point out that CLOs and mutual funds, mutual funds, as well as these new structures that emerged that took place of the hedge funds, they are all market-driven, right? So only the banks are regulated. CLOs, there is a risk retention rule, but this is largely shadow banking. And so these are all market-level disciplines. And I'm going to bring back Gary's point, and that we are under the illusion that these things we shouldn't be under the illusion that these things will evolve very gradually. And so we should keep an eye on the monitoring liquidity, with understanding that by looking at the average liquidity, we are not assessing the tail risk. And we should keep an eye on the structures of the market and understanding that those structures are market-driven and they can deteriorate over a medium horizon. Thank you very much.
How do I get it up on the screen? Okay, let me start by saying thank you for the invitation to be here today. And I have to start by saying these are my views and not those of the Federal Reserve Board or its staff. Thank you. So I'm going to start also like Victoria, where I largely agree with Darrell's assessment on market liquidity. Changes are occurring. Effects are still playing out. Moreover, if there were some dips in market liquidity where even less liquidity could amplify risks, it may be coming at the benefit of a more stable financial system. Since I agree, I'm just going to try to add to the discussion a bit today and bring some additional points by focusing in particular on the interactions of dealer market making and the increased role of investment funds, or asset management. To emphasize a few points up front, I would say first, there have been important structural changes in fixed income markets that preceded the crisis. In the corporate bond market, the TRACE system, which Daryl mentioned, the trading, reporting, and compliance system, was introduced in 2002, required timely disclosures in 2005. And then we've had the growth of proprietary automated trading in some markets, which had started in equities and FX and have now moved to parts of the treasury market. And these kinds of developments have definitely removed the sort of the information advantages that dealers have always had. Since the crisis, dealer market making has been reduced, and I would argue both because of their own risk management practices and from regulations, an intended consequence. Low returns, low interest rates may also be a factor. And then finally, in addition, the increased, since the crisis, the growth of credit provided by mutual funds has grown substantially, which I will show you. In principle, this shift in credit intermediation is stability enhancing. These entities are much less levered. However, there seems to be concerns that they may face spikes in redemptions, and combined with market liquidity could amplify price declines. Okay, so I'll start with two slides here, which are going to show, which I will use to show that the financial sector is more resilient. Gary may say I'm being short-sighted, but let me just point to this. This is credit market debt as a share of GDP, and it's shown by the type of financial intermediary that's providing the credit. The dark blue at the bottom are banks as a share of GDP. That's been steady for decades, starting in the 60s. Insurance companies right above that, and pension funds also pretty stable. And then in pink, you can see that's the GSEs. So that started to become a big part of the system in the 2000s. At the same time as the GSEs, then I would call the areas between the light blue and orange as shadow banking. This includes your finance companies, your broker-dealers, your asset-backed securitizations, your money market funds, et cetera. And these grew rapidly since the mid-'80s, but especially in the lead-up to the crisis. These have contracted sharply. And then finally, yellow is the growth of the mutual funds since the crisis. And since the crisis, it's really the only group that's been gaining share. Okay, second slide is just a different way to think about the system, which is the whole financial system relies a lot less on short-term wholesale funding than it used to. This is a chart of aggregate short-term funds, which includes repo, sec lending, money market funds, CP, et cetera. It's lower in the years just preceding the crisis. The recent rise is the expiration of the transaction account guarantee, the insured deposits up to $250. So again, in principle, financial stability would be enhanced when risk shifts from firms that are more leveraged and more stable funding. Okay, so turning a little bit closer to market liquidity, this is another change in the system. These are dealers, and this is positions in different kinds of debt securities. The right-hand side, dealers are holding fewer securities in inventory. This is what the press picks up quite a bit. They make it suggest that that means if they hold less inventories, they are doing less market making. This is in aggregate, and you can see in the past few years it's fallen. But on a net position, it's a little lower. It's back to levels around 2007. On the right-hand side, this chart here is just to kind of illustrate there's a lot going on behind net aggregate positions. Corporate debt inventories, the red line, has been about flat for the last few years, maybe shaded down a little bit. And the recent declines have really been in treasuries, and that's the black line. And there's a pretty significant negative correlation between these two, since dealers use treasuries to fund their corporate positions. Perhaps the more interesting point here is we don't tend to view that these net positions are a very good indicator of dealers' willingness to make markets. You can look at the positions in 2007 and 8, large positions, and would argue that this did not at all signify a greater willingness to make markets once prices started to fall. So I think we have this unresolved issue, which is you can have high inventories, perhaps with a high leverage, or you could have low inventories and low leverage, and which ones will generate more market making is still an open question. And then here, I'll go through this quickly. This is just 2 indicators of market liquidity in the corporate bond market. I'll make 2 points here. First, this market's never been very liquid. It's probably not liquid now. It wasn't liquid before. That's like a key point. If you look at bid-ask spreads, that's like 100 basis points, versus treasuries, which are like 2 or 3. So they're pretty high. And then the share of trades that are greater than $1 million, 10 or 20 million. This is from the Trace system. I guess the second point is these trends don't show any correlation with the changes in net positions of corporate bonds. Okay, so one possibility for why market participants seem to be quite concerned, and it's this possibility that you could get a spike in the demand for liquidity, and dealers are not going to be able to provide that liquidity. That's what is the concern. So here, I would say we do have growth of mutual funds, clearly sharp rise. The right-hand chart shows I'm going to focus on high-yield bonds because those are not that liquid. High-yield bond market size has been growing pretty rapidly over the past few years. The bond mutual funds, that blue line, have grown also. And as a share, they've picked up because they're growing quite a bit faster. Mutual funds, though, have been around for a long time. In 1940, for 75 years, they haven't notably contributed to systemic risk. But they are becoming a bit more specialized, and they are becoming bigger players in these less liquid markets, and that seems to be generating some concerns. So 2 things a couple areas why funds might cause problems. First, and the SEC is looking at this as well as the Financial Stability Oversight Council. What was a very simple intermediation chain has gotten a little bit more complex. First is this move to less liquid assets. So there's a fundamental mismatch between the on-demand redemption of mutual funds and the kinds of securities that they're holding. There's also a first mover problem in the way the U.S. mutual funds are structured. Funds mutualize the cost of asset liquidations, and so these costs are borne largely by the remaining shareholders. So combined with liquidity mismatch, this creates an incentive for investors to get out ahead of the other. This is your kind of run, although you wouldn't kind of put it in the same category as a run, like a bank run kind of thing, like a diamond dip big run. So nonetheless, these could amplify the effects of redemptions and greater asset sales. And then the potential of these mutual funds and reduced liquidity could certainly amplify any kind of credit cycle. So I just wanted to wrap up by just mentioning a couple things that the SEC is working on. So the SEC is taking a fresh look at the fund industry. The 1940 Act was 75 years ago. Liquidity risk management is one of 5 initiatives. So the proposal they issued in September tries to address a couple of important things that I highlighted. One is, how do they do liquidity risk management when the fund is investing in illiquid assets? And 2, can it help to remove this first mover advantage? So there's a number of things to do on liquidity risk management. They are asking funds to report assets by liquidity buckets and disclose more frequently. They're asking for 3-day liquid asset minimums. Gary will hate this. This will be, so you have to hold at least 3 days. Board oversight of liquidity risk management programs, and greater disclosure. There's also an option for swing pricing, which is a feature of mutual funds that is adopted in Europe, where a fund can anticipate in large outflows the effect on the net asset value. So you can swing down if you're expecting large redemptions. It's been adopted in other places, so it's possible here. And then, and so more broadly, besides this illiquid assets, mutual fund intermediation has gotten more complex. Funds can use derivatives and they engage in sec lending. These are two ways that are just kind of leverage returns. And so the SEC is planning proposals on stress testing and the leverage. The Financial Stability Oversight Council is also reviewing these issues. In practice, it's possible that any regulations aimed at individual funds may not be sufficient for systemic risk. For example, would they capture correlation risk versus idiosyncratic risks? Or would stress testing of funds capture that you're likely to have funds redemptions at multiple funds, not just at one fund? So I think the goal for these financial stability reviews is to assess the structure of the intermediary, not to regulate asset prices or moderate asset prices. And it'll be work in progress for the next year or so. Okay, thank you.
For that, and I apologize to Victoria. So her slides will be on the Hutchins Center website at brookings.edu, and I personally will mail a full color copy of her slides to anybody who's desperate to have them. So I thank you for being such a good trooper. It seems I'm always a little bit overwhelmed by these discussions because on one hand, you hear the industry saying that these guys in Washington and Basel, and they're mostly guys, don't know what they're doing. Gary's got it exactly right. They don't really understand how the markets work, and they are going to make things worse when we have another crisis. And on the other side, you have people saying, some of the complaints of the industry give me a headache. They're saying that we can't do everything we could do before the crisis. And then you say to them, yes, that was the point. We didn't want you to do all that stuff. We didn't want so much leverage. We didn't think that anybody being able to trade anything, any moment, was necessarily good for the society. So we're caught in this tension, and I want to tease out a little bit about how that fits in this conversation. So in our attempt to get a diversity of views on the stage, I don't think we didn't represent the people in the industry who are most worried, and so I'm going to try and channel what, as best I can understand, is the industry argument. And I think what they're saying is, you all are too complacent, that we haven't tested anything yet. We've had an extraordinary period of very low interest rates that we know is abnormal, and we've had a couple of minor shocks, but what makes you so confident that if there was something that happened and there was a big spike in prices in the bond market, that some big bank would actually come in and be willing to buy them, which is what we need to keep the system stable? What makes you so sure?
Thanks, David. Well, I think my last remark was it's too early to tell. I think that is a risk. On the other hand, a lot of people on the buy side would say, well, they never came in big to supply liquidity to the market during a stress period. Of course, it's all relative. If they have the ability to supply some significant amount of liquidity, that's good. But I do think it's too early to tell. We may have some air pockets. The question, though, is when it happens, and it probably will, how will that shock get transmitted to create financial instability? And I think you heard both Victoria and Nellie say, look to the bond funds or look to the leveraged loan funds to see they're not going to fail, the banks are not going to fail. Who's in the next tier?
So is that a good thing that we've moved the risk to the leveraged loan funds and the bond funds because they're less systemic? Is that basically the argument?
Well, Darrell in his slides, I don't know if it made it to the final version, had this point about who exactly would fail. And mutual funds cannot fail by definition, and so you can kind of have needs a chain of accelerating forces. And so I do agree that moving off the balance sheet of the banks is an important point. And just to echo Darrell's point about this starting argument about the banks coming in and providing liquidity into the market, that's not what we have seen during the past crisis. And there is actually a piece of research with very micro data from Bundesbank in Germany, where they actually look at who's buying what, and they illustrate the fact that there is not much role of a bank as a provider of liquidity in that.
Right,
context.
so we don't have to worry them not doing it in the future because they didn't do it in the past. But let me just push you a little bit on this mutual fund thing. A mutual fund doesn't have to fail to cause a problem. If we have, as Nellie pointed out, lots of mutual funds who have similar portfolios, and they all try and sell at once, and it turns out some of their stuff is illiquid, so they sell all the liquid stuff at once, then you could get the fire sale bad dynamic that we know is a problem. So it's not good enough to say a mutual fund can't fail.
So I think you raised the point about whether the mutual fund could amplify any kind of price decline, and I think this mismatch and the first mover advantage has that potential. So having regulators look at that and try to fix that seems like very on point. I think the other thing to mention is there are going to be bond losses. People will take losses. Prices are going to fall, and so I think you want to make sure your intermediaries, the funds or whatever kind of institution, don't amplify those and make them become a bigger problem. If it's just a liquidity issue, it could mean, so it takes me 3 days to execute a trade versus 1 day. If it doesn't actually permanently alter the prices, it's not
Right.
as much
So
of
the
an
whole
issue.
purpose of finance is to mobilize savings so that we can have investment and live better happily ever after. Darrell, what would you have to see, what would you be looking for to see whether this liquidity in the bond market was a bigger problem than you suspect? What would be the warning signs that would tell you that it might be too early to tell, but it's not too early to worry?
I mentioned already the reduction in the repo market. That's a clear danger sign in terms of liquidity. I don't think it's a financial stability problem per se. I think you should look to costs of issuing debt, because we've been talking about the secondary market where already issued debt is traded. But why does liquidity matter? Well, in part it matters because when the United States government wants to roll over its debt, it wants to get a nice low interest rate. And if secondary markets are illiquid, the United States government, therefore all of us in the room mostly, are going to pay higher taxes to cover that debt. That's important. And then you already raised the point of, could there be down the road somewhere a shock to the market sufficiently large with insufficient liquidity to absorb it that somehow propagates to other players. And we haven't yet got the end of that story.
And there isn't any sign, is there, Victoria, that corporations, or at least investment-grade corporations, are running into higher transaction costs to sell debt, are they? They're selling a lot of it.
And the same is true for the high-yield segment, because the shortage in mutual funds that we observed over the last 8 quarters or so was more offset by presence of CLO issuance, while
Collateralized loan obligations.
yes, collateralized loan.
Let me ask one final question before we turn. So I think the reason that people worry, or one reason people worry, is they recognize that we could have a big reaction when the Fed starts raising rates. If not the first time, then when the markets conclude that rates are going to go up a lot faster, and it could be a very disruptive event. And if it's going to be disruptive, it seems like one place it might be disrupted is the bond market. Do any of you have any concerns that we're too much extrapolating from this period of tranquility now, and that we'll look back a year or two now and say, like, well, that wasn't the representative period?
Yeah. Well, as I mentioned, that might actually improve liquidity because there's going to be more reasons to rebalance your positions, more trade, more turnover.
Right.
And it's not as though we haven't had time to prepare it. The Fed has been telling us for quite some time, get ready, we're going to start doing this soon.
Right, the only volatility was the day they said they might do it and didn't, right?
I think as some of the emerging market governments have said, let's get on with it and see how it works out.
Okay, I'm sure they'll have some questions. Phil Suttle here.
Thanks, David. Phil Suttle from Tudor Investment Corporation. Actually, one observation up front. August '07, didn't a closure of or the closing the gates by a mutual fund in France actually kind of wasn't that the first domino in the whole crisis? So the idea that mutual funds can't have systemic implications strikes me as a little odd. But my question is really partly based on Nelly's slide on the growth in the post-crisis period and the growth of the ETF market. Because I think when we think about concerns that we have about market structure and how it could go wrong, you know, it typically comes from a market where you have illiquid assets backed in some sense by a promise to deliver instant liquidity. And that seems to be the ETF market in a nutshell. And we saw some of this in August this year when, I can't remember the exact data, but something in the first 15 minutes of trading, the SPX, which is the most liquid ETF, was trading at something like a 20% discount to underlying for just a little while, but
Right.
It was enough to really scare people. So I wondered if Nelly in particular, but other participants had some thoughts on whether it's really the ETF market we should be most concerned about.
So in August, that particular incident was an equity ETF, which was related to the late opening of the NYSE and the quoting of stocks. So I think it was China over the weekend. Futures were down before the NYSE opens, and so then there's standard procedures for how you open stocks, and so many stocks, maybe like 800 or 1,000, didn't open on time. So ETFs couldn't quote the underlying stock prices, and so there were some big gaps in there. I didn't hear, so that was the issue, and I think that is something that could be remedied. They could not allow ETFs to trade until the underlying stocks were also trading. That could address that. I didn't hear issues in terms of bond market ETFs, which I think some people have raised more questions about. So it is a liquidity issue, but not, the stock markets have practices in place where they know how to open and close stocks. These things with big price moves. Don't think we took a big lesson from the liquidity yet, but it was something to watch.
Anil?
Anil Kashyap, University of Chicago. I guess I have a hard time getting this to a financial stability story, but having pressed people in the markets, I think the story goes a little bit like this, which is the high-frequency trading has meant that the bid-ask spreads now don't mean what they used to, because the trade sizes have fallen so much that we don't really know that if somebody had to put through a big trade, what it would mean. So a lot of the calm indicators are untested. So I think the best story for financial stability would be, let's suppose something happens late in the day where you get one of these big spikes because somebody has to put through a big trade, and then you see movements that are very, very large and a bunch of closing prices get quoted in the middle of one of these flash crashes. Does that strike me as super likely? I don't know, but I think the thing to keep your eye on is when we get back to more normal trade sizes, or whether we ever will. And if we never do, then I guess you're only going to find out when the tide goes out as to how this all works.
Okay, I think there's one on the aisle here. Pete Kyle. Pete, raise your hand.
Hi, I'm Pete Kyle from the University of Maryland. You presented some information from a pessimistic standpoint, and when I look at it, I see optimism. So you talk about declining trading volume in bonds, but yet the rise of mutual funds and ETFs. And I don't know whether your volume statistics included not only net redemptions from mutual funds, but all the gross redemptions from mutual funds. That should probably be factored in when thinking about how much volume there really is in terms of change of ownership in bond markets. And similarly for ETFs. you talked about banks making less money off of their dealing activities and having less repo position. Well, making less money off their dealing activities means their customers have more money in their pockets. That to me is good. The banks having less leverage on their balance sheets. Well, look at the picture we saw of the banks' long corporates and short treasuries in massive quantities leading into the financial crisis. And then when the financial crisis hit, they had to delever. So they got crushed not only on liquidating their bond markets, but they also got crushed on liquidating their treasuries, which were skyrocketing in value at that time. So it seems to me that things are probably much better than you say, and that if we do see what would look like a run on mutual funds, what we should expect to have happen is for spreads to widen. Bond prices will fall, the market will clear. The companies that issued high interest rate debt will have a chance to buy it back at even higher rates. And that's the way markets are supposed to work.
Any comment?
I'll take a quick shot at that. I was already the optimist relative to Gary, so things are looking even better as you go down through the audience. I think some of what you said is true, because we're taking some of the action away from the core payments and settlement system, where a lot of it doesn't need to be. It could be in the asset management industry, far away from banks, and not impair them. One of the things, though, you said can be taken two ways. When the banks make less money, somebody else is making more money. Well, yes and no. Nellie mentioned the idea that now that the market is more transparent, banks' bid-ask spreads are narrow, they're not going to make as much money, and their customers are probably going to have less trading costs. On the other hand, the prices they're charging are for a service, and some of this reduction in bank revenues is a reduction in the amount of services supplied, so turnover down, for example. So there might be less, this is what liquidity means. It might be more costly to move positions through, or it might take you longer to do that because of this. And as I said, this is a trade-off I'm happy to make, but we just need to be aware of where it's going.
Steve, last point.
Thanks. Steve Cicchetti, Brandeis International Business School. I have two quick points. First of all, I just want to point out that what you just said, Daryl, is, again, an intended consequence, which is the idea is that the low cost of bank balance sheets, the low cost that banks had for having their balance sheets large, was effectively subsidizing the trading in a lot of these markets. That subsidy's now at least been somewhat removed, and so we have to decide how we feel about the fact that the costs have now gone up. But we might ask whether or not having stronger institutions means that if the cost of trading does skyrocket, they will be strong and have capital ready, that they will be willing to devote to now a higher return activity. The question is whether they'll have the infrastructure for that. I have a separate question, though, about market structure. The Treasury, the U.S. Treasury issues 300 and some securities. Large corporate issuers issue many, many more. And this is, forget about leveraged loan issuance, okay? But I have some numbers here, like JP Morgan issues 671, Bank of America 1,066, Goldman Sachs 1,783 separate bonds. Can we do something? It seems to me that that's a prescription for illiquidity, and a prescription for problems in bond mutual funds if they start holding this stuff. Is there something that we can do to improve the standardization of corporate bonds and make that market more liquid that direction through a structural change?
I'll comment. First comment. The corporation seems very uninterested in that proposition. So, it does get raised with them, and there are some who have benchmark issues, but in general, they like the flexibility. They have certain investors they like. They want to be able to offer them what they want, when they want it. So it has been raised. A few companies do this. The UK reopens their gilts. The US does not, so that seems like a ability to think about.
Well, I think it's a good place to take a break, and thank you for the opportunity to tell you that during the coffee break, you can buy either Ben Bernanke's book or a little book that we've published at the Hutchins Center called The $13 Trillion Question, in which John Cochran makes exactly the point that Steve says, and why is the Treasury creating all this arbitrage opportunity for the bond market? Why don't they issue perpetuals and let and take some of the rents back from the dealers for the benefit of the taxpayers. We're going to take a break of about 10 minutes, so we'll get back here at, say, 3:35 to hear from Dan Tarullo. Those who may have questions for Daryl or the other speakers, we'll have a little panel at the end. We'll have more time for questions. So thank you all. Come back in 10 minutes.